Thanks for joining us for your closing markets. Mark Schultz with North Star Commodity joining us on what has been a really tough down day in all the grain and livestock futures. Another risk-off session. And what can we compare this to, Mark, in terms of, kind of the risk-off environment that we've had, especially spilling over here from these recessionary fears from the outside markets?
Well, if you're going to get into a recession, and that's obviously what the market is starting to lean towards, the stock market poking the new lows again, and the dollar rising, and the dollar, the bigger thing to the upside, and that probably suggests a dollar at 114 now. I think we're going probably to 120, maybe 122, something of that nature. Hopefully that stops it. But when you're doing this type of a market atmosphere and nervousness, you're going to have a lot of things start showing up more bullish, because it's going to be pretty easy to find bearish information, because you're just going to lose your export demand and you're going to lose overall, just see things going downward. Now, if you get into and we talked about this before, if you get into a recession, just a minor recession, it's not a problem. But if you start doing something that's a significant recession, then we could start talking about things that date back to 2008 when overall commodity prices fell. And now I don't know if we'll go quite to that extreme, but nonetheless, you could certainly take a lot of the shine off of these markets, and there's still plenty of shine to take off.
Do you think that we have seen demand destruction yet, or is there evidence of that? Because export inspections on grains weren't that great this morning.
Yeah, we're definitely starting to see the export demand fizzle here. It's just not as strong as we need to. Granted, we're that last week of September, and typically October is a big month where we start seeing a lot of business being done. But like I say, with the currency where it's at, and in the situation that we're at in the equity markets where it's at, I still maintain the world's going to buy grain from everybody else but us. We're going to be the most expensive, and then you got to tag on the shipping. So it's not like they're going to run to the U.S. and say, this is a good deal, I'm going to buy their grain. I think it's going to be a wait and see and sit on their hand routine. And that may very well be what we have too. Not a lot of buying in advance, just more of buy just what I need when I need it. Okay,
so more hand to mouth for sure. So what about on the livestock side of things? When we get into dollar making new highs here, how much does that curb what we're doing in terms of, exports? Especially, it seems like hogs are more sensitive than cattle.
Well, the hogs are more sensitive because you have more exports going on in the pork on a percentage wise. So we're far more dependent. When you do 23 to 25% of all your production gets exported, you need that export business to keep that market in check. If we start losing that, and not only do I think you could possibly lose some export business, which we've already done, I think you always got the risk that we might keep the imports up a little bit higher than what we normally do. So those are the problems that we're facing here in the hog industry. Cattle, not so much. Now, what the beef has a problem with is that if things really start to get tough as far as consumption of beef, which has been very good in the first 7-8 months of this calendar year, we may start to see that taper off here as we go into the last quarter of 2022.
So do we need to be really concerned in cattle and hogs just because the funds are so long in this market again?
Yep, good point. The cattle have been on a buy, and we talked about this. If you look at it, fundamentally on the cattle, they look very friendly. Okay, that's withstanding. That's not a problem. But what has been the problem is everybody is bullish on the cattle. And what we did here last week is we posted weekly key reversals down in the cattle futures, and that is a bearish technical signal.
That's right. In the hog market, it already kind of seen its slide, but it probably has some more downside risk, you think?
Well, we've had 4 sharp down days on the hogs, and we talked about this the last time, and I still have been on the bearish side because it also had a weekly key, daily and weekly key reversals down a month ago or so. And all this did was just get a rally back on up, and those rallies failed, and we've been down ever since. But 4 hard down days, that should come to a halt here, maybe get a rebound, but overall the trend is down.
And over on the grains, the other thing we're going to be watching here towards the end of the week, we have small grain summary, but the bigger one will be the quarterly stocks report. And what do you anticipate?
Well, if you look at just the sheer numbers, and they don't change the size of last year's crop, we're going to be dealing with some pretty big export or carryouts for corn, 1.525, maybe 1.55 billion bushel carryout for this year. And the beans will be about 270, 275 would be my guess. Wheat looks like it'll be about the same as it was last year. That's what we're pegging it at.
Right. And we're getting some early yields. And what are you hearing there?
All over the place. I would still say if you're the western third of Iowa, western third of Minnesota, going into the Dakotas, Nebraska, Kansas, your yields are coming up short of expectations. On beans, I'd say right now, granted, it's only early, but they're running anywhere from 5 to maybe 10 bushel less than last year. Once you get to the center part of the state and on the east side, the yields are getting back more of equal with or a little bit better than what they had a year ago.
So the cash basis levels, are they going to stay as strong as they were last year during harvest? And what is the grain stocks report going to tell us about how short this crop is and where we might see those cash basis pushes?
Well, that grain stocks report, if they, again, unless the USDA comes back and says last year's corn and soybean crop was overstated, we're going to have a bearish grain stocks numbers unless they change those last year's production numbers. That's the only way out of the box out of that one. And with the basis as tight as it was for both corn and beans, one would think we should be seeing some type of adjustment. But we saw that same pattern last year, and it did not happen.
We are going to have some regional shortages, though. In some places, it's going to be tough to even get feed for some of these cattle, isn't it?
Down to the south, yes, there's corn is extremely tight. I have heard that we put some wheat into some of the cattle rations out in the western parts. Back when wheat at one time about 4 weeks ago got within 50 to 60 cents of the price of corn, we saw some wheat already going in there because it was actually cheaper with the freight. Once you had to add in the freight, it was cheaper to put the wheat in. So we did get into some feed rations. How much, I'm not sure of, but at least I've heard rumblings of that taking place.
A lot of interesting components going on in the market right now. Thanks for joining us. That's Mark Schultz with North Star Commodity. Okay.
We got did you hear that?
Yeah, I could.
Yeah. Do we have to do it over, do you think?
No, let's not.
I'll wait until these guys are out. They'll be gone in about 5 minutes, 10 minutes.
Okay.
It's the association, so they come by. Usually they're not here until